Let's play a quick game. Be honest with yourself. Think back to a time when you saw an asset, a stock, an index fund, or crypto skyrocketing. Everyone was talking about it. YouTube thumbnails were screaming about generational wealth, and your group chats were on fire. You sat on your hands for weeks telling yourself, I'm smart, I'm not falling for the hype, but it kept going up. Finally, at the absolute peak of excitement, you couldn't take it anymore. You surrendered and threw your money in. And almost like magic, the exact moment your order went through, the market turned over and started to bleed. You watched your hard-earned money shrink day after day. First came hope, then anxiety, and finally, at the absolute bottom, when the despair was too heavy, you hit sell. You breathed a sigh of relief. And what happened next? Within days, the market bottomed out and launched into a massive rally without you. Welcome to the most expensive phenomenon in finance: buying high and selling low. The bad news? It's costing you a fortune over your lifetime. The good news? You aren't stupid or bad with money. You are simply operating on standard human biology. Today, we are opening up the human brain to understand why this habit is so hard to break and how you can rewrite your programming to stop feeding Wall Street your hard-earned cash. To understand why we buy high and sell low, we have to go back 200,000 years to the African savanna. If you were an early human and you hear a rustle in the tall grass while 5 members of your tribe scream and start sprinting, do you stand there and run a cost-benefit analysis on whether a saber-toothed tiger is actually there? No. If you do that, you get eaten. Your survival depended on 2 rules. Follow the crowd. If everyone runs, run. Flee immediate pain. If something causes danger, get away instantly. For 99% of human history, these instincts kept us alive. Herding meant safety. Panic meant survival. Now, fast forward to today. You take that exact same caveman brain, sit it down in front of a laptop, and give it a brokerage account. Here's the glitch. The stock market is the only place on Earth where human biology works completely backwards. When a stock price rockets up, your brain sees the rising crowd as safety. It signals, look, everyone is running over there. It's safe. Join the herd. So you buy high. When a stock price plummets, your brain treats the drop as an immediate threat to your survival, a predator attacking your bank account. It signals pain, danger, get out now. So you sell low. Every time you buy at the top or sell at the bottom, you aren't failing a math test, you're falling for an evolutionary trick. 3 psychological drivers enforce this habit in your day-to-day life. 1. FOMO, fear of missing out. When you see asset prices rising without you, your brain experiences social exclusion. You feel like everyone else is getting rich while you're getting left behind. The financial pain of missing out feels worse than the risk of buying at the top. Eventually, your willpower breaks, and you buy right when the asset is most overvalued. 2. Loss aversion. Psychologists Daniel Kahneman and Amos Tversky proved a revolutionary fact about human nature. The agony of losing $1,000 is twice the intensity of the joy of making $1,000. When your portfolio drops by 30%, the mental agony isn't equal to the happiness you felt when it was up 30%. It feels existential. To make the paper loss stop hurting, your brain looks for the fastest exit route. Hitting sell converts a potential loss into a permanent reality, but it buys you immediate emotional relief. 3. Regret avoidance and confirmation bias. Once you buy at the top, you don't want to admit you made a mistake. You hold all the way down, seeking out hyper-optimistic influencers to protect your ego. But eventually, the drawdown becomes so severe that your desire to avoid further regret overrides your ego, and you sell at the worst possible moment. You might be thinking, does doing this a few times really matter that much in the long run? Let's look at the numbers. Every year, research firm Dowbar releases a study comparing the performance of the overall S&P 500 index to the performance of the average individual investor over 20-year spans. The results are shocking. While the broad market averages about 10% annually over long periods, the average individual investor often earns less than half of that. Why is there such a massive gap? It's the behavior tax, the penalty paid by investors jumping in and out of the market. They buy after the market has already rallied 25%, buying high, and they pull their money out into cash after the market drops 20%, selling low. Then, while sitting in cash waiting for things to settle down, they miss the initial recovery phase. Missing just the 10 best days in the market over a 20-year period can cut your total returns in half. And those 10 best days almost always happen right in the middle of a market panic. You can't change your evolutionary biology, but you can change your environment and your systems. Here is a 3-part framework to eliminate buy high and sell low forever. Step 1. Automate everything. Remove the human. The single best way to prevent emotional decisions is to take your brain out of the loop entirely. Set up dollar cost averaging, DCA. Automate a fixed dollar amount to buy your chosen index funds on the exact same day every month, regardless if the market is up, down, or sideways. When the market is high, your fixed dollars buy fewer shares. When the market crashes, your fixed dollars automatically buy more shares at a discount. Step 2. Invert your emotional signals. Train yourself to treat your emotions as a contrarian indicator. When you feel an overwhelming urge to buy an asset because everyone is talking about it, tell yourself, "This is my brain feeling FOMO. It is time to sit on my hands." When you feel a knot in your stomach and want to sell everything because the headlines look terrifying, tell yourself, "This is loss aversion talking." Historically, maximum panic equals maximum opportunity. Step 3. Stop watching the ticker. If you look at your portfolio every morning, you're exposing your brain to constant micro-traumas. Check your long-term portfolio once a month, or better yet, once a quarter. Out of sight, out of mind, out of panic. Building real wealth isn't about outsmarting Wall Street, guessing market tops, or picking the next viral stock. It's about mastering yourself. The market is simply a mechanism for transferring wealth from the impatient to the patient. The next time you feel that urge to chase a skyrocketing stock or sell off during a scary drop, pause, take a deep breath. Remember that your brain is just trying to protect you from a saber-toothed tiger that doesn't exist. Recognize the trap, stick to your system, zoom out, and let time do the heavy lifting. If you found this video helpful, hit that like button, subscribe, and drop a comment below. Thanks for watching, and stay grounded out there.